Hey there, good afternoon traders. This is Trader Tim from E-mini Mind doing a Monday market analysis video. It is the 28th of June, 2021. And last week there really wasn't a ton of intraday price action, even though we trended up a fair bit on the S&P. I only had one trade for scratch, and that was it. So the takeaway here is that sometimes when we get into these continuous new highs, or we're constantly pushing into new highs, you can end up with days, like this morning, where if you look at the first, in today's case, if you look at the first 30 minutes, we had a large enough range in that first 30 minutes. I put it on 30-minute candles here, to where we've stayed inside of that range the entire morning. I mean, with this little exception of peaking down below over the lunch hour, there has not been anything going on. Look at the 512. If I zoom in just a little bit, I mean, there's really not much to do in here. If you try to draw up retracements in the middle of the range, you just end up with, a stop out, stop out, stop out. Maybe you can get to a first target or to a break even, but fighting the fighting the setups or forcing the setups in the middle of a choppy range is really not that beneficial. Um, I tend to be a little bit more on the conservative side, where I'm really focused on limiting my drawdowns, keeping my P&L and my net worth and my income and those kind of things constantly going up and to the right. Where with trading on the 512, I probably could take a few more chances or a few more trades because it's pretty easy to get to that break even point. But on weeks like last week, there's just not a lot of opportunity out there. I mean, look at, it's another sideways day, but, trending up, we gapped up and then moved sideways. Friday, another gap up, and then for the most part, moved sideways. You go back here to Tuesday, just sideways all morning. And then Monday was really the only day where we trended off of the open. And so if I go back here, one thing I wanted to point out on those, especially on Mondays, on those Monday where you tend to see more of the gap and go days. So this is Monday, the big body candle. One thing you can do, if I go back to the 15-minute chart, is come in here. So this is a gap up on this first opening bar. If you use that first 15-minute bar to be your trigger in such a way where you're buying when price moves above the first 15-minute bar, you can catch a longer trend like this. So if you're just buying a tick above that first 15-minute candle, every single candle here makes a new high, and all you really have to do is trail your stop underneath the next 15-minute bar until you get taken out up in this little consolidation here. You can also try and hold into the close with a little bit wider stop. That works sometimes too. But if you come in here and try and draw up a retracement, I mean, just taking from the low of the morning, we really don't have any major pullbacks. And so those days, when you're in the context of a gap up that's occurring after a downtrend, and that's really key. It's not just any gap up. It's a gap up that occurs after a move down. You can, look to get a little bit more aggressive off that first 15 minutes and just, using a buy stop to just get in and try and ride that trend. Same thing back here on the 20th, a gap up. And then even back here on the 13th, not everyone is going to go gap up and then rally into the close. But if you keep a 2-point stop, your chances of catching, if you have, let's say you have a couple of gap and goes like that per month in the context of a pullback. You really don't need very many if you're going to be catching, sometimes 30, 40, or even 50 points if it's a huge move. And so taking a little bit of risk with the typical 2-point stop when there's not really any other opportunities throughout the morning, to me, those kind of risk rewards are worth it. So just a little idea for you to play off those gap ups at lows. I got another question this week about, you know, using. So I talk a lot about the Vanguard VUG fund. This is the fund that I use, just a basic growth ETF, alternative to a mutual fund. And so I use this fund in my retirement account as well as sort of what I would consider like a short-term savings vehicle. So I have retirement account that I'm not really touching until I can't access till 59 and a half. A lot of you have 401ks and things that are tied to that age. And so if you're already over 59 and a half, but not forced to take required minimum distributions, putting money in there is not really a big deal because you can access it if you're already over 59 and a half. But if you're in your 30s, 40s, 50s, and you want to kind of bridge between, maybe you don't want to retire at 65 or 59 and a half, and you want access to capital in the meantime before you reach that age. I have just a basic brokerage account here with Thinkers TD Ameritrade, and I buy VUG in that account. And so yes, I'll have to pay capital gains, but it's long-term capital gains. So rather than just piling a whole bunch of money in a savings account that's not really doing anything, using that account to every week, put some money into, and just constantly be adding, and being able to catch some, dividend growth and returns like that when you do need capital for, buying a rental property or investing in something else. You can pull those funds from that account. I wouldn't use that money, to go buy toys with, but if you're going to use that money to invest, or like I said, buy a rental property or buy your first house or something like that, that's a good way to do it. So it can be a little bit slow to get started because you want to get some money in there, get past that 1 year mark so that you're not paying short-term capital gains, and then build enough cushion where if you got $100,000 in there and you want to, you see a foreclosure in your neighborhood, or you want to become a landlord and buy something, or take the money out and you want to invest some of it in Tesla or some other opportunity. It's there for you. You pay a small amount of capital gain, but if you just piled all that money in a savings account, with inflation, you're really losing money. So that's my technique for kind of short to midterm savings. And I do have cash, obviously, but there's not really need to have a huge amount of cash because in a pinch, you can always access that money. It's super liquid. Credit cards, things like that. I'm not a huge proponent of racking up a whole bunch of credit card debt, but in an emergency, there are options. So the last thing I wanted to touch on, let's see. So this week we've got a handful of catalysts as far as economic news. Home price index tomorrow, consumer confidence tomorrow, the usual jobless claims on Thursday, and then the employment situation on Friday. And some of those numbers are, comparing year over year, not going to be very beneficial. Comparing month over month, okay, a little bit more trajectory that we can actually project out into the future. And then things like, home price index, we know home prices have gone up quite a bit, so expecting some large numbers there. But the consumer confidence one might be a little bit of a curveball. Not exactly sure what we'll see with consumer confidence. But then things like construction spending, manufacturing on Thursday, that we should you could expect to see less spending because there's not as many opportunities of things to buy, but the cost of goods have gone up. So it may end up being a wash as far as you're spending more, but you're not getting as much. And so there can be some knee-jerk reactions when some of these numbers come out, but when you really dive into them, there can be some more insightful information if you just take a little bit of time to look through it. So if we go to a couple of different markets here, take a look at the VIX, back in the low teens, not much to read into there. If we look at the S&P, you can see I've got these two retracements on the chart. Both have negative 23% targets that are pretty close to each other. So yeah, we're riding the top of the trend line as we've been doing for basically the entire year. But I do think we have some room to go higher. What I want to watch for is if we have a couple of days in succession that are gap up and go, close at highs, next day, gap up, go, close at highs, where we could start to see a little bit of a overbought situation or an extended situation, a blow off top. There's a handful of different names for it, but it's there reaches a point where it's just not quite as sustainable anymore, and the buyers have sort of dried up. So I don't think we're there yet, but those are what I'm watching for when we start to get up into the new high territory day after day after day. So if we go to the Dow, though, not anywhere close to returning to those highs, and also already starting to kind of break Friday's low. NASDAQ looking really strong, up at its negative 23% target. Same thing, I've got the two drawn up, a larger one and then the smaller one within that. The reason I drew up the smaller one is because this high broke above the prior swing high. So I drew that one up inside of it. We had this little double bottom and then pretty hefty run up, and kind of a nice 45-degree angle, which is looking good for tech. And then the Russell just kind of fizzling out, I suppose. It's kind of, if I hold my cursor around like this area up here, we've kind of made our way up there, got a new high, and then really haven't been able to do that since then. So not a lot going on with the Russell. If we just take a glance over at the ES, a handful of unfilled gaps that are below us, but not too many. I mean, we've done a pretty good job in last month filling most of the gaps that we created. And so now we've got, these gaps are pretty far away. Like if I drew up from the most recent swing low to high, yeah, a 50% retracement can knock out these two most recent ones, 58.50 and a 33.50. But, the low where I'm basically grabbing my anchor point from, or the close rather, is where the next gap is, and that's quite a bit away. So there's lots of things that could act as a catalyst, especially on the global market front. So even if things are looking super neat and tidy and like nothing can shake the market, you always want to just kind of brace yourself. And so it doesn't hurt as you get up into these new highs, especially if we have gap and go, close at highs. Next day, gap and go, close at highs. You do that 2 or 3 times, and you make a huge run up to like 4,300 seems pretty attainable this week. But if all of a sudden we blow up to 43.25, 43.50, okay, now I'm going to be looking to put on some put protection and hedge some of those long-term positions in a little bit of a overbought situation. So tomorrow morning we'll be doing a live trading session. You can tune into that over at eminimind.com/VIP. And if you have questions, drop them in the comments below. Thanks and have a great week.